The S&P 500 formed a death cross today for the first time in 3 years, a type of technical pattern used to help determine the start of a potential bear market. A death cross is kind of like the check engine light for your car. It doesn't necessarily mean that the engine's blown, but it is a warning sign that something could be breaking down under the hood. A death cross forms whenever the 50-day moving average, which is kind of like the short-term mood ring of the market, slips underneath the 200-day moving average. That one's kind of like the long-term memory. There have been about 24 death crosses in the S&P 500 over the last 50 years. But it doesn't always mean doom and gloom. As one analyst pointed out, 30 days after the death cross, the market is higher 60% of the time. And some of them don't even last very long, like in March 2020 when stocks fell in the pandemic before quickly skyrocketing. That death cross only lasted a few weeks. 3 years ago, the death cross lasted for 11 months before finally giving way to a golden cross, when the 200-day moving average goes back, a sign of everyone's favorite bull market. The downward pull of this particular 50-day moving average really shouldn't be much of a surprise. The market fell about 20% in only 7 weeks due to tariff unpredictability. And even though we're up 12% from the lows of last week, we still have a way to go.